Hi there. In this business topic video, we're going to introduce the concept of stocks and also introduce the idea of stock management. Of course, stocks are the raw materials, the work in progress, and the finished products, the finished goods that either enable production to be scheduled and operated, or, for example, to enable a retailer to meet customer demand. Most businesses operate with stocks of one form or another. Just a word of warning, you may also see the word inventories used for stocks. They mean exactly the same thing. Stocks are inventories. There are three main types of stock in a business. There are the raw materials and components that go into the production process. For example, it could be components that are assembled into an electronic device. It could be the raw materials that go into a manufacturing process. When those production processes are underway, we have what's known as work in progress. In other words, non-finished or unfinished stock. A good example of this would be construction, a housing estate, a new housing estate being built. That's work in progress. A road being laid and built. That's work in progress. But similarly, items that are going along a production line until they finally get packaged up, those too are work in progress. And at the end of the production or the value chain, we have finished goods, goods that are ready to sell. So, to summarize, three main types of stock: raw materials and components, work in progress, and finished goods. Now, why does a business hold stock? There are a number of reasons why a business will want to make sure it holds stock. Firstly, as we've already mentioned, for raw materials and components, of course, you need these to enable production to take place. And similarly, a retailer or a wholesaler needs stock in order to be able to sell to customers, to be able to satisfy customer demand. But also, stocks are quite important to allow some protection for the business. For example, to enable the business to meet a sudden or short-term unexpected increase in demand. Maybe to enable the business to handle seasonal changes in demand. And also to enable production to be scheduled efficiently, to make sure there's enough raw materials and components for the production lines to run without running out of raw materials. There's also a concept called buffer, that the need for stock to ensure that you don't run out, you don't have a stock out, or that there's a delay in production processes. Lots of reasons why a business needs to hold stock, but of course it doesn't want to hold too much stock. Key influences therefore on how much stock a business held or holds. You can categorize them in three main ways. Firstly, the amount of stock you hold will be related to the need to satisfy demand. A business that doesn't have stock but has customers wanting to buy is in danger of losing those sales and losing the customer relationship. A business also needs to be careful how it manages its working capital. Don't forget, if you're holding lots of stock, that's cash that's invested in that stock, cash that could be used elsewhere. So another key influence on the amount of stock is the extent to which you need to manage the amount of capital that's tied up in inventories and stocks. And thirdly, another influence is the risk of those stocks losing value whilst you hold them. In general, the longer that you hold stocks, the greater is the risk that they may not be able to be used or that they can be sold for their full value. So, as you consider how much stock to hold and as you consider ways in which you can manage stock, and we'll take a look at stock control charts and processes in a separate video, you need to think about the cost of holding stocks. And of course, it's not just the cost of buying the stock in the first place. You need to pay for the storage. So the cost of storage would include things like warehousing, but also the employees and the equipment and the facilities to be able to manage and handle those stocks. There is a cost associated with interest or finance because you've tied up capital in buying the stocks. So the interest cost could be fairly significant. There's also a risk, as we've mentioned, that the longer the stocks are held, the greater is that they may not be able to be used. They become obsolete. So for example, a retailer with stocks that have perhaps passed their sell-by date or a product that's gone out of fashion has a higher degree of obsolescence risk. And also there's a cost of not holding stocks, the stock out cost. If a customer comes into the shop, you've not got the stock or the product that they want to buy, then you've lost the sale unless you can find a way of getting the product to them. So you need to think about the stock out costs as well as the costs of holding stock. That's been a brief introduction to the concept of stocks and stock management.